What's up, everyone? We got a really good one today, and so strap in. And of course, all the OG house cats, drop a meow in that chat. You're watching More Money. Let's get it. What's up, guys? I've been getting some requests from you guys to cover the options as well. I know you guys really like it, and so let's go through the options. So I guess the first thing is that recall that they made $5.8 billion of share repurchases in the quarter. This is Alibaba, by the way. In the amount of around $81 per ADS. And so, the first thing I think about when I think about share repurchases for Alibaba is we might potentially, as demonstrated here, get a lot of support at around that $80 to $85 range, because it just seems to be the area where they're comfortable repurchasing securities. And so, the shares being in that range right now probably means that they're doing quite a bit more of repurchases at this price. And so really what you're doing is you're taking the pessimistic shareholders out of the equation, and you're just getting left with the people that believe in Alibaba more and more. And of course, those people are willing to pay more and more as the outstanding share count continues to decline, and they're really using that excess capital to buy back shares. Now, I know some of you guys have been saying that, it's probably better if they redeploy that capital into the business. And yes, that makes sense in many circumstances. Just Alibaba is one of those companies that has grown so large and they're so cash flow positive that they don't really have the ability to redeploy that capital at high rates of return that other smaller companies might be able to. Now, Tencent does a really good job with this, but even Tencent has built up a major a war chest of equity securities because they just can't redeploy all of it into their business. So what do you have left? All you have left is accretive share repurchases under what would be considered the stock's fair market value. Now, when it comes to fair market value, let's go in and see what that actually means. This is the valuation that I have on the tracker. And, you can see there's a couple of valuations here just using a terminal multiple of 12.5 times earnings, which is very close to where their multiple is right now at around 10 times earnings. You can see that the valuation of the company is around $140 per share. Add in that excess cash. Now, I did not add in any value for the equity method investees, just being a little bit conservative, nor did I add in the restricted cash. Now, some people don't really understand what that means. Generally, you'll have restricted cash from the perspective of a balance sheet, but, your treasury can use it. And that's definitely the case anywhere that I've been, but just to be conservative, I've taken that out of here as well. And so, you get an addition of $34 per share. And so you can get up to a valuation of around 173. But what does it look like relative to the current share price? Well, the share price as a percentage of the valuation at $173 per share is, trading at 48%. But just taking this $34 out, so if you were to just say, listen, I don't want to take into account any of the excess cash because I think that the cash that's on the balance sheet is needed to run the business and keep the business defensible, which is a very strong argument. Then in that case, you'd say the shares are trading at around $140 per share or 60% of its intrinsic value. So this is your baseline. But then what does this mean as we go into options? And, generally selling cash secured puts, the whole point of it is to reduce the risk of the overall investment. So, you might be purchasing the security at $83 per share as part of the covered call, but because you're getting such a large premium, because generally I go long dated, it would bring your net purchase price much lower than this. So, your net purchase price could be at like $60 per share, which means that, even net of the cash, you're probably going to end up sitting under 50% of the calculated valuation. And so let's see how that works. And of course, I just showed you the model for Alibaba. You can get access to that model at the lower tier of the Patreon. And if you want to join us for a live call every month, you can join us at that higher tier. So just a quick plug for you guys. But okay, taking a look, this is Yahoo Finance. This is the January 16, 2026 calls, and you can see for the $85 per share, which is roughly around where the stock price is right now, you can get a premium probably in that $14.5 per share area. And I always get this question from people that watch the channel, why do you use such long dated calls? And the reason why I use long dated calls is because this premium will materially minimize my downside risk. When you use shorter dated premiums, you will get a higher a percentage of a return on an annualized basis, the premium divided by the share price and then annualized. However, you don't get as high of a downside risk protection. And so, the whole point of using options as a value investor is to further reduce your risk. And so that's why I go with the longer dated call. So, I know that question is going to come, and so I'm trying to answer it ahead of time. And so here is the covered call calculator, return calculator that I do make available for free for you guys. I once upon a time I wanted to charge for this, but then I'm like, what's the point, man? The whole point of this channel is to help people learn. And so I gave this away to you guys for free. There's a lot of work in here. If you guys have any questions, please reach out. Or generally on our monthly calls, if you want to ask questions about this, I've never really gotten a question on this on our monthly calls, but if you guys are confused, let me know on the monthly call and we can go through this one by one, like line by line. But as you can see, there's Baba, trades on the NYSE. I put in the exercise date of January 16. I put the strike price of $85. I put the premium of 14.5, which is what we were expecting. And let me just confirm that. Let's go back here. Yeah, 14.5. The last trade is 14.7. 14.5 might be on the high end, maybe 14.25, but it's same thing. Largely the same thing, I'd say. And so, they are paying $1 per share in dividends, so I threw that in there. And so really what's happening is you have a binary with options. So if you are assigned on the covered call and you lose the shares, what is your return? Well, you get your premium, you get the theoretical amount of dividends. It's $1, but because your holding period is more than 365 days, that 41 cents takes into account that. So just from a accuracy perspective, I left it like that, but from a realistic perspective, you'd just put $1 in here, so you can override this. And then your capital gains or loss. Well, the company's trading at $83, you lose it at $85, so you make a little bit of a capital gain as well. So overall, your cash inflow is $17.73. Take off 41 cents if you want to be a little bit more accurate. And it's not going to change the answer materially, but your annualized yield is 18.3%. Of course, your simple yield is 26%. So over the 560 days, you're going to make 25.8%. However, annualize that using 365 days, you're going to make 18.3%. Assuming that you're assigned. Now, what happens if you're not assigned? Well, your cost basis goes down to $68.68, and you compare that to the valuation of $173 per share, you can see that the cost basis as a percentage of the valuation is, just about 40%, which is amazing. Now, what happens if you use the cost basis relative to the unadjusted valuation, so the 140 as opposed to the 173, and really that 140 reflects not taking into account the excess cash. So the excess cash valuation, it still gets you to under 50% of the cost basis. Now, generally, I like the equity yield to be around 15%. So this is not a perfect relationship here. Definitely not as great as it was a couple of years ago when I was going hand over fist into these Alibaba options, but there's still money to be made here if you're interested. And so nothing's guaranteed. The share price could go down way below 68, and you could be very much a loser. If it goes down to $50 per share, well, then you're down 1868. So just be aware of what a covered call investment is, but also keep in mind that if the stock rips and it goes to $150, all you're going to make is your 1773. So understand exactly what covered call investing is. The whole point of this is to reduce your downside risk, but you give up your upside potential. And so that's it for the covered call video. I know you guys find it very valuable. And of course, if you want access to the models, please consider joining the Patreon. There's over 200 of us. And you can join that $5 a month tier, or if you want to join us for an epic live presentation every month, you can join us at the higher tier. And of course, if you join and you don't like it, just let me know and I'll completely refund your first month's subscription. Okay, I'll leave it there for you guys. Let me know what you think about the relationship of the covered call, and let me know if that's something that you're considering. Of course, this is not an endorsement of any of that. It's more just giving you the information so that you can make your own decision. All right, I'll leave it there. I'll see you guys later.